serious with them. I didn't beat around the bush. I wasn't kicking the tires when we picked a property to look at. I was selective about which ones we went to go look at. I didn't waste their time looking at every property. And then when we looked at a property, I was decisive. I would tell them after viewing the property if I was in or out, and if I was in, I made an offer that day.
Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
J-Love, we're doing good today, J-Love. Can't wait for this interview.
It's going to be a good one. Today's guest is Mike Dymski. Mike and his wife are proud parents of 5 awesome kids, one less than Gino, so I guess we do have some Brady Bunch action going on today. He is a graduate of the University of Georgia. Big game this weekend. Go Vols. He is also the VP and Chief Accounting Officer of a public financial services company. What he left out of his bio, though, is he, too, is a multifamily madman, but we'll get into that here in a minute. So without further ado, Mike, welcome to the show.
I appreciate y'all having us. Those introductions are incredible, and I guess between Gino and I, we probably could field a basketball team game against one another, and sounds like we've got a sub as well. We do.
Throw my daughter in, she can do some water girl on this side. So, anyways, so how's it going today?
Good. It's great to be here, guys. It's really an honor to be on your show. I've listened to some of the other podcasts here over the last couple of months, and you guys have a great slate of guests and professionals on the show, and hopefully as a part-time investor, I can try to keep up.
Well, we're really excited about it, and that's one of the reasons we're so excited to have you on the show, is because sometimes it's hard to relate once we have almost 700 units. So someone starting out might say, well, that's like a pie in the sky. How the heck do you get there? And I think this is going to be a great opportunity for folks to learn more about you and how you got started out. So why don't you just tell us a little bit how you got started in your first multifamily deal?
Sure. So when I was originally looking for a home, this goes back to 2004, I was looking just for a primary residence and wasn't looking for an investment property. But I did want to buy a property that had appreciation potential more so than just my dream home. I was single back then. I was looking for a condo or a home in the downtown area where I was living. And my real estate agent took me by some of the condos, and there weren't many on the market. The downtown area hadn't really grown or emerged yet, but the ones that were available were a couple $100s a square foot. And I thought, hey, for Greenville, South Carolina, at that point in time, it's a little steep. And so they were investors. They showed me to some of the houses in the surrounding areas, and ended up buying a fixer-upper, small 2-bedroom, 1-bath house for $130,000. So it was right around $100 a square foot. And I thought, man, if I can buy property that's just a half a mile or 3/4 of a mile away from a potentially emerging downtown area, that's a good investment opportunity for me. So a couple months later, I went out and bought my first single-family home to flip. So here I was, single, a renter my entire life, and now I owned 2 homes and had no idea if I had any ability to flip this house or any type of repair abilities underneath me. So it's all been history since then. So I've flipped a few homes over the last 12 years to raise some capital, and accumulated 34 rental units in that time period.
Awesome.
As well.
That's great.
So that's what really got me kicked off.
Let me go back a little bit. I love your story. Can you just tell us a little bit about your story, how you get down to Greenville, what job you're doing, where you're living right now?
Sure. So I'm in the what's called the upstate of South Carolina, town of Greenville. Interstate 85 runs between Atlanta and Charlotte all the way up to the Raleigh, North Carolina area, and that whole corridor of 85 has had just steady growth. It hasn't been booming, but just steady growth over the last 10 or 15 years. I grew up in the Atlanta, Georgia area, went to University of Georgia, graduated from there, and came up to Greenville to work for a regional CPA firm. Predominantly worked in banking and financial services. That's who my clients were at the time. And then I went and worked for one of my clients after that. It was a regional bank in the area. And so I've spent most of my career in financial services. And that gave me a little bit of background for the real estate investing as well, because I can crunch the numbers pretty well.
So, Mike, the $1 million question that Jake and I always like to ask is, why real estate?
So, for me, the why is pretty easy. It helps support my family. I've got a family of 5 kids. Yes. Oh, when I was single, I didn't get married until 2011, and prior to that, I was single, no kids. So, real estate was really my savings. It was going to provide early retirement funds for me as well. But then my why changed a lot in 2011, and I had 4 stepkids out of that marriage. I took financial responsibility for 3 of those stepkids. Their father had passed away years before that, and so the real estate cash flows started becoming cash flows to support car payments, mortgage payments, insurance. Gino, I know your kids are a little bit younger, but wait till
it's coming, buddy. It's coming. The storm's coming.
Hey, get this. We actually had our car insurance payment. I've got 5 drivers in the house. Our car insurance payment was higher than our mortgage payment at one point.
Oh, man.
You throw a couple of teenage drivers in there with a few accidents and some tickets as well, and 5 drivers, and it cost a fortune. But it just makes everything really worthwhile. Have a wonderful family, a wonderful wife, and the real estate helps with that. Over the course of time, when the kids are out of college in probably about 5 or 6 years, that real estate's still going to be there, and it should provide financial security and financial freedom for my wife and I, and open up a lot of opportunities for me.
That's great. So what is your investment strategy?
Well, I've always been a value-add investor, regardless if it was a home that I was going to flip or something that I was going to keep, or the apartment complex that I closed on earlier this year. With having a big family and a 60-plus hour a week job, I don't have a whole lot of free time for investing. So any free time that I had and any investment that I make, it had to be really impactful, really high rate of return. And buying something that needed a little TLC and needed to be rehabbed with that value add potential is core to my strategy. Now, what I've done is, some of the houses that I flipped early on, I guess, in my investing career, I was doing that just to raise capital. I just didn't have any money back then. And so I flipped those. Others along the way I have either flipped or held on to, basically more based on their appreciation potential or their location, so I've kept those. And then others I've flipped instead of kept them because they maybe weren't in the prime location, or the last house I flipped I sold about this time last year was a 5-bedroom 4-bath house, high-end renovation, and it just wouldn't make a good rental because the rents would be capped at a certain point. So I flipped that one in the same neighborhood where I've kept other smaller properties that cash flowed better.
So, Mike, let me ask you a question. What do you think value-add investing is to you? How would you define that?
So, I use the term forced appreciation, if you will, where you can go in and renovate the property, rehab it in some form, increase the value of that property, and you either have instant equity as a hold investor, or you can sell the property and you've got a capital gain.
That's our strategy. Yep.
And this is, he brings up a great point, because this is a big difference for the listeners out there, because the difference between forced appreciation and what you see going on the coasts, New York, California, a lot of these people that are investing in these markets are not getting cash flow. They're investing hoping to ride the wave and that the market itself will take the appreciation up. What Mike does is he goes in, he sees something that's undervalued, rents are below market, he goes in, fixes it up, and then he's driving NOI. So based on the income approach, he's forcing that appreciation up because it's becoming more profitable because he's the way he's operating it. Huge difference, way more control, way more sound, to me, investment strategy.
I think that's very well said, and you guys are doing the same thing as well. A lot of us are in real estate investing because we like the control. When you're working in a W-2 job, unless you're the CEO or the president, you can even be at fairly high levels of management, and you're still at the mercy of other people's decision making. Well, in real estate, we have the control, and if you buy a value-add property, you can control what its value is, in particular in commercial, by driving that net operating income up and not necessarily being at the whims of the market. So, I need to have that control right now because I need to know what's going to, happen with my family and be able to provide the finances for my family. I can't just be at the mercy of the market. Maybe later on when I have less pressing financial matters for immediate needs, then I can ride the market a little bit more. But right now I like having control over that appreciation.
Mike, where did you start getting your education in multifamilies?
Well, School of Hard Knocks.
That's right. That's awesome.
I love reading. I love listening to podcasts, but I just don't have a whole lot of capacity. When I say I work 60-plus hour weeks, I mean there are many weeks that's the minimum, and I've been doing that for most of my career. I've always worked for really fast-paced, growing companies, and so it just hasn't left a whole lot of time for other things. And so if I have to make a decision what I'm going to spend my time on in real estate, it's either going to be deal execution on one hand or it's going to be education on the other hand. And so I've chose to spend most of my time on deal execution, which in turn has educated me both the good way and the hard way.
That's great. So I want the listeners out there to hear that he's making no excuses. He's doing a ton of work. And what I like about his strategy is he can still work full time and still do real estate part time and still generate a ton of money. And that's how Jake and I started. We were both full time guys. We started on our first 25 unit deal. And that's what I think is so often overlooked in multifamily, because for you to buy a 25 unit single family home, you've got to be running around the whole town and not being able to scale up. And our model and what Mike is doing, you can still work full time. And you can keep your full-time job and do real estate part-time. And if you want to transition out of your job, you can have that luxury. I think it's a lot harder with single-family homes. I mean, that's just Jake and ours opinion. But every time we interview somebody, that's what it seems like it comes down to, having that luxury where you can do both.
But what Gino's basically saying is stop making excuses and just get out there and make it happen. Keeping it simple. Just do it. I'm freaking do it.
I'm trying to be the nice guy. I'm trying to be the politically correct guy by saying yes. But in reality, Jake is right. We all have excuses. And my thing is why I asked Mike your why. You have to have a strong enough why. Because if you don't have a strong enough why, you're going to dilly-dally. You're going to listen to podcasts for the next 3 years. You're going to be on Bigger Pockets, talking to everybody, listening to everybody saying there's no deals in the market, and you're not going to find.
And meanwhile, everyone else did 30 deals in that time, and you're sitting there.
That's right.
That's right.
When you have a why, like 6 kids, or you have a why where you're not growing, you're not being fulfilled, or you just want to get something going on in your life, you're not going to do it. So that's why I think it's really important of that question of why.
Mike, Jake or Gino, I'll give you kind of a prime example with me. I closed on this 29-unit apartment complex. I bought 25 units in one transaction and then 4 from a separate owner in a different transaction. But what that's enabled me to do is I've actually had more time since I closed on that apartment complex. That 29-unit apartment complex takes me about the same amount of time that my last flip did last year. It's crazy, 29 units versus one single-family home. So over the last couple of months, I've been able to walk around the house and have my cell phone on, hooked up to podcasts and listen to your podcast and a bunch of other podcasts. I've plugged into Bigger Pockets and have been active on there. I've actually been backfilling some of my team members with, looking at working with tax attorneys and vetting them, looking for a CPA that specializes in real estate. These are things that I didn't have time to do before, and I can't imagine it would have taken me a lifetime to purchase 29 single-family homes and all those individual transactions. I mean, shoot, I've been actually just trying to get a home equity line on my primary residence just for kind of equity stripping and asset protection purposes and creating some additional capital. It's taken stinking 2 months, and they're still working on the thing.
Residential's nuts.
Commercial real estate deal closed quickly, and a bunch of professionals.
I'm not even going there, but yeah, you're right. Bottom line is those. I'm doing a refi on my house, knocking it down to 10 years right now, and we can close a 300-unit apartment complex quicker. I can close this stupid refi. So I don't even want to go there. Anyways.
But Mike, the powerful thing is about the 29 units you just bought, those are cash flowing. Those are for creating wealth. You still have those. The single-family fix and flip is gone. You created the money, so it's two different strategies. The first one, a lot of people on this call might need it to create that capital to get it. But what I want people to understand is fix and flip is a job. It's a different mindset. It's a different paradigm, I think. When you're fixing and flipping a house, you need that money. You have to go on to the next one. I mean, we had Jay Scott on, and it was the same thing. He's fixed and flipped over 200 homes. Can you imagine that? That is some massive business going on. But at the end of the day, he's got nothing in his portfolio where he can say, okay, I'm financially secure. And he's going, and that's his next step now. He's going to do that. He's continuing with his job. But I like the 29 units you have because those are going to be there 3 years from now, 5 years from now, and you're going to continually cash flow and start making money on that deal. That's what I love about it,
Yeah, I specifically stopped flipping. I said after my last flip that I was going to do buy and hold, at least until my kids were out of the house. And I specifically was looking for something more passive. And so I vetted crowdfunding. I vetted increased passive investments. I invest passively with a real estate developer who builds discount retail stores. And so I just cut checks for those. So I vetted, expanding my passive investments, crowdfunding, and some other asset classes. And I decided that multifamily could potentially be the most passive, but give me the greatest returns as well. Because, I'm essentially flipping this apartment complex, if you will. That doesn't mean that I'm necessarily going to sell it, but we are rehabbing and turning units and creating value with each unit turn. But the great part about it is I'm not rehabbing it. I'm not managing the contractors. I'm not managing the rent collections. That's all being handled by professional third-party management, which is just a different model than I was under with a really highly active strategy with flipping.
That's great. You want to tell us your first deal and what you learned from that very first deal?
Yeah, so if I kind of take you back to what I mentioned earlier, I was hadn't been a homeowner before that and didn't know how handy I was going to be, so I bought that second property with in the same neighborhood where I was living, and didn't know a whole lot about rehab. I had made some estimates of what I thought it would cost to rehab that single family home. I had also hoped that my father, who was in construction, or he was really a white-collar worker for most of his career, and when the kids left the house, he quit the white-collar job and just worked for other investors and did handiwork on the side. So I brought him up the first weekend after I closed the house, and he worked on the house for a couple of days and then went back to Atlanta and didn't come back after that. I had never, spoken with him ahead of time about it, so, he wanted to just stay closer to home, be at his house. And so I had to go out and figure out how to, find general contractors, search for them, vet pricing, where to purchase supplies, the whole 9 yards. A couple interesting things about that property is, if I go back a little bit to the financing of it, I didn't have a whole lot of money at that point in time. I had just bought a personal residence, put a down payment on it, and so I was strapped for cash, and I'm like, man, I've got to figure out find a way to finance this property. So I took an 80% first mortgage on the property and closed a 20% second mortgage HELOC, I guess simultaneously or right after the first mortgage. Back in 2004, you could kind of do some of that junk. But in addition to that, I had probably $55,000 or $60,000 worth of rehab that I had to finance as well too. And so I took a 401k loan, and I also took a interest-free cash advance on either one or two credit cards at the time to finance the renovation for the property. A couple other interesting things about that particular unit. I remember we had a torrential rain storm the day of closing. I closed late in the day on a Friday, and so I thought, hey, I'm going to go by and check out the property, see how it held up. Most of the properties in that neighborhood, their basements were what are called wet basements. They don't get really wet, but water seeps in through the foundation, and then they all have sump pumps in them that pump the water out into the backyard. And so I went over there, and the basement had probably 4 feet of water in it. And
swimming pool.
It's interesting. That's actually how I got the water out. I had to rent a pool pump the following day, but it was over top of the HVAC equipment. Water heater. Long story short, but when some foundation work was done over there, somebody had unplugged the sump pump, and so the water had accumulated. So I show up at the closing table, And I'm sitting there with my agent. There's a seller's agent there. The seller's there who had inherited the house, and he wants to get rid of this piece of crap house. The attorneys are there. Everybody's looking for a commission. Everybody's looking for...
Everybody eats, right?
Closing. Yeah, including me. And so I mentioned the water, and I didn't have... cameras weren't really prevalent, cell phones back then, and so I mentioned that there were 4 feet of water, and I just got a bunch of blank stares from everybody. But in the end, my real estate agent kind of stepped up and said, "Hey, Mike, I'll put a home warranty on it. I'll pay for it." We did the closing. Following day, went back over there, pumped the water out with a pool pump, and everything was fine. I think I had a $125 or $150 HVAC repair and good to go. But in the end, I guess the moral of the story is just had to plow through it and figure it out. Just use my general business acumen and figure out a way to flip this property and generate some capital.
Wow, that's a great way to start. You had no money, credit card, 401k. Sounds a little like Jake and me.
Yeah, scrapping. Right? That's the thing, though. You got to be resourceful in the beginning. Just figure it out. And the biggest thing in real estate, especially starting out, if you can solve problems, you're going to be successful. And when you find the way to solve problems, you're going to generate cash flow down the road for yourself. So.
Wow. Yeah, beg, borrow, and steal. And at that point too, it was still low risk for me. I mean, I had a good feel on what the market was gonna bear and what the value of the property was gonna be after renovation. I was single, didn't have a lot of kids. With the value that was going to be created, whether I flipped it or kept it, I was gonna have a lot of equity in the property 3-4 months into the renovation. And so it wasn't a really high-risk venture. Either that or I just didn't know any better at the time.
Sometimes that's the best way to do it.
How many units do you currently own, Mike, and how many units do you want to own?
Sure. So I've got 34 total units. 29 of them are in that apartment complex. The apartment complex is a bit of a proof of concept for me. Both, to make sure that I can execute on, transaction that size. And then secondly, just want to see if I enjoy it. Right now everything's going really well. If it continues that way and I'm able to continue to build my systems and processes on that size property, it'll create the foundation for me to purchase a much larger property. And frankly, what I'm looking for is something that fits the professional multifamily management model. Radically different model. There's a bit of a management void, if you will, in units, say 10 up to, pick a number, 75 units in my market. There's likely a void like that in many markets across the country where those properties are too small for the professional multifamily management. But then if you work with the single-family residential managers, they all would like to do it. They all can handle it pretty well, but they don't have the same multifamily contacts, the same vendors, the same business model to be able to turn units quickly. And so it's a bit of a challenge to be able to work through that right now. I knew that going in, but it's a bit of a stepping stone just from a financing standpoint, experience standpoint. If that project goes well, when the property is renovated, stabilized, and rents are raised, I could possibly refinance into long-term agency debt, take the cash out of the property, and roll it into a larger complex, which hopefully would actually have even more efficiencies.
So, can you walk us through that value add that you're doing on the apartments on each unit, and just let us know how much you're raising those rents, what the rents are now, and what you estimate rents to be once it's raised?
Yeah, so you guys are going to be very familiar with this model right here because it's exactly your mom and pop wheelbarrow profits model. I mean, it is identical to what you guys are doing on a lot of your properties. And so I was specifically targeting a value add property. When I approached commercial mortgage brokers, I kind of walked through what my strategy on that was. And I wasn't looking for something that was really destabilized. I wanted something that was fairly stabilized, that didn't want extensive rehab. And so I ended up purchasing a property that was, only 25 years old. It was owned by the original builder of the property. He had successfully built the property and managed it through multiple business cycles. And he was going through retirement and just liquidating his portfolio. And so what I'm doing with it is I'm going through a bit of a mini repositioning. I recognize that I felt that the rents were below market. They they weren't below market for the existing condition of the property, but they were below the potential in the market. And so we're going in and just taking care of, minor deferred maintenance on the exterior. So first thing we did is, clean the gutter out, clean the gutters out, had the exterior facade pressure washed. Any of the exterior wood surfaces are getting painted, so the shutters, the front doors, the back doors, the trim around the doors as well, and the front porches, just giving it a fresh, clean looking exterior facade. The landscaping was a little bit overgrown, so the lawn was taken care of, but there were some trees that had grown up where they didn't belong. There were some saplings that were growing up through some of the bushes, some vines where they didn't belong. So just kind of easy stuff where we have the landscape company go in, and something simple as just, defined edging of the property and cleaning it up on the exterior. And then I guess if you turn to the interior of the units, those are pretty straightforward as well, too. So right now, all the units on the interior are all completely white. The trim, the walls, some of the doors and closets are just that wood look, and so it's a dated look. So we're going in with a kind of a contemporary two-tone paint scheme across the entire unit. We're replacing the flooring in the units. We're going with...
What are you going with flooring?
We're using a wood look vinyl product. I mean, these vinyl products are awesome. I mean, it's almost hard to tell that they're not hardwood floors, and the tenants love them. They're very easy to keep clean, and we're doing that in the entire first floor, including the living room, and so it gives it a nice, clean, modern look. Changing out light fixtures, making them more contemporary looking light fixtures, and taking down some dated looking wallpaper. So overall, just the overall concept is just to give it a nice, clean, fresh, modern look and a safe place for the residents, and they seem to be very receptive to it.
How much is it costing you per unit to flip?
It's maybe $2,500 to $3,000. It's not a lot. Frankly, if I was working with a professional multifamily management company, it may even be less. I had to connect the single-family manager with a multifamily flooring vendor and a multifamily painter, but it's really not that expensive to put new flooring and new paint and some new fixtures.
Just keep shopping and beating those guys down. You'll get it down to 2,000 eventually here.
What are the rent bumps on there, Mike? You're getting?
So taking the units from approximately $500 a month up to $625 a month. Nice. There's actually the potential to take it even higher. There's a similar looking property across the street from me, same facade, but that property, they're not going through the same transition that I'm going through, and so it's harder to put a $700 or $800 a month tenant right across the street from a $500 rental. So we'll see over time if maybe they follow course with me, but able to raise the rents 20, 25, 30%.
So this is really important, guys. I have a couple of points to make here. Number one, he's spending $2,500 per unit, and he's getting a $125 rate bump. At the end of the year, he's got about $1,300. So it's taking him 2 years to get his initial investment back. What other business can you do that in? Very few businesses you can get your initial investment. The second thing is he's increasing the NOI, so everyone is going to give him another $1,000. If you're going 30 apartments, it's an extra $30-something thousand. At a 10 cap, to make it simple, it would be an extra $300,000 in value that he's done by spending $2,000 per apartment. So it's a strategy that we can all do out there. And I hear these terms that Jake uses all the time: two-tone paint scheme, vinyl look. It's not stuff that's rocket science, but it's stuff that you guys got to learn. And all you have to do is find somebody out there who's doing it and copy them and mirror them. We're not rewriting anything here. We're not remaking the wheel, as we like to say. It's stuff that's out there, and it's not hard stuff. And I like that Mike targets stuff that he doesn't have to do the heavy lifting, because Jake and I feel the same way. We don't want to go in there, rip out cabinets. We don't want to go in there, put whole new bathrooms in there. We want to do roofs. We don't want to do parking lots. It's stuff that is the mom and pop, the quintessential mom and pop that Mike just described, that the owner is retiring. He wants to get out of the business, and it's just what we're finding in our market.
And keep shopping it too, because I've got these cabinet and countertop resurfacing guys, and I'm just blown away with what they're able to do. And to rip out cabinets and replace cabinets, that's the last thing I want to do. I want to resurface, get these things looking new again. Little gooseneck. Gooseneck's my new favorite one. Doing the little gooseneck faucets, people love those, and it's working well. So
Yeah, that's one thing we haven't done yet. So the cabinets are actually in really good shape in the,
that's
in the
great.
units. And we could paint them, we could replace the hardware on them, and we could easily resurface the countertops as well too.
Mm-hmm.
And I've been working with the property manager to try to find the sweet spot as far as rent goes. Right now, we feel that we are at the sweet spot and maybe at the maximum with the renovations that we're doing. But once I have all the systems and processes in place and our vendors set for doing the renovations, I've got flooring set, I've got painting set. Maintenance has been a challenge for us. I think we've got a good guy now. We'll see how that works. But
it always seems good in the beginning. Just give him a few weeks, right?
Hey, don't even get me started. I mean, I could go on and on about contractors, and I'll come back to that in a minute. But once that's set, I'm going to test market maybe a unit or two and resurface the counters and paint the cabinets.
See what you can get. Yeah.
Yep.
Yeah.
I mean, shoot, I could, if I get just a simple $15, $20, $25 rent raise from doing that, I can easily justify the cost of that renovation.
Mm-hmm. Mm-hmm.
And that's what I love about multifamily. I'm a pretty pragmatic guy. I'm a CPA. I'm not the most vocal or exciting person to be around, but I get giddy as a schoolgirl when I do the math that Gino just did a little while ago on, hey, if a $25 rent increase times 12 months, take out a little vacancy, take out a little management fee. How much in renovation costs can I do to achieve that? And you multiply that across 25 or 50 or 150 units, and before long you're looking at 6 and 7 figure cash out refis and rolling into the next property.
I like it.
So maybe I'll touch on contractors a little bit, like we mentioned maintenance, and I saw you laugh on there, and obviously subcontractors are one of the biggest challenges that we all face in real estate investing. And the thing I like about the multifamily management model is we're working with what I would call vendors as opposed to contractors. And for me, there's a huge difference. And so the flooring vendor that we work with, they're a professional, large company that has regional buying power. And when you reach out to them, you're using automated communication with them. It's text messages, it's emails. Somebody's going to be there every day of the week. They're answering the phone, automated invoicing and whatnot. And then they do the dirty work and manage the subcontractors. And on top of it, it's a good business model because those subcontractors, these vendors are a gravy train for them.
Mm-hmm. Just keep feeding them.
They have to show up every day. They have to do a good job. If something's not done right, they have to go and fix it, because if they don't, the gravy train gets shut off. And so it's a radically different business model than you and I sitting there and individually manage, contractors on a small portfolio of properties.
Wow, Mike, let me ask you, how have you built your teams and your systems in the multifamily?
So first things first, getting a good realtor was key for me on the single family side. Mm-hmm. I worked with that realtor for over 10 years. She was an investor herself. I vetted a lot of realtors before I bought my first primary residence to live in, but I was specifically looking for somebody that was an investor and was looking at long-term appreciation potential. And in the end, she's a closer. I mean, she gets deals done, and I have purchased and sold a majority of my properties through her. She's got a great network. She maintained probably usually around 3 properties herself as investment properties, just buy and hold, and she would sell one every once in a while, maybe after the capital gain holding period. But she was just wonderful to work with. And so when I jumped in the apartment arena, I had to try to find something similar on that end. It didn't take long to find out who the 2 key multifamily commercial brokers were in my area. They had a majority of the listing, a majority of the deal flow. So I reached out to them.
How'd you find them, Mike? How'd you find them?
Looked on LoopNet and see who had most of the listings. I called just some of my contacts in the area on the single family side and asked them who they were working with. Asked some of my asked my CPA. Asked my network. But the main thing is I just wanted to find who had the most deals.
Mm-hmm.
And so I fostered a relationship with those guys. Told them what my strategy was. Told them what I was looking for, and most importantly, told them the capital that I had available. I mean, that's what they want to hear. They want to know what you've got, and and that you can close the deal. And then the other thing I did is, I was serious with them. I didn't beat around the bush. I wasn't kicking the tires when we picked a property to look at. I was selective about which ones we went to go look at. I didn't waste their time looking at every property. And then when we looked at a property, I was decisive. I would tell them after viewing the property if I was in or out, and if I was in, I made an offer that day.
That's the way to do it. That's great. That's awesome.
As far as the rest of the team, I'm backfilling that a bit. So like I mentioned earlier, I am vetting real estate CPAs. I've always done my taxes myself, but now with an apartment complex and potential cost segregation that would go along with it, I need to bring in the experts, and so I'm looking for a CPA right now, looking for a bookkeeping package as well. Also vetting tax attorneys and asset protection strategies. So, I went out and bought the property first. Some people will get those things up and running ahead of time. I'd prefer to get the property going, running, cash flowing, get processes in place, and then backfill some of the important things, but maybe the less important things that don't need to be done before the deal is executed.
I like that strategy because what happens is if you do it beforehand, your focus is not on making the money. Your focus is on everything else. So you have to focus on getting a deal done. Then you can form your LLC, and that's what Jake and I did. With our first 25-unit deal, we didn't have any teams. We had nobody, and we ended up getting the contractor, the inspector, like a week before. Then for our next property, we had somewhat of a team, but it took us a good 6 months to a year to actually fill that team out. So I think most guys do it our way. Because if not, you're going to get completely overwhelmed. I mean, you're going to have to get the CPA on board, the attorney on board. You're going to have to get all these guys on board, but you have nothing to do. So I'd rather have something to do and then get them like you did,
Totally agree.
The great thing is, too, is after you're in it for a little bit, you have this team built around you. So, okay, this needs to be done. Pick up the phone. You do it. You're hitting a button, and everyone's kind of just doing their part. And it's so much easier after you've been in it for a little bit because that is such a pain vetting these people and getting the right partners in the beginning. And then once you have them, it's great. So
yeah, some of these relationships are critical. Mm-hmm. It's just interesting you mentioned team and partners. Our multifamily painter actually fired us a couple of days ago, and I was like, man, this is a really important vendor for us. It sounds kind of silly, painting, we can go out and there's lots of people that can paint, but frankly, there are not a ton of multifamily specialists that exclusively work on apartment complexes. And once again, that's a very important vendor for me.
Mike, here's the thing. I thought the same thing. You would not believe in the last year how many of these guys have come out of the woodwork, and I found out that because how many people? What's the population of your city?
So the MSA is around 1 million, but the submarket that I'm in is 200,000 for this particular property.
But they'll travel up to 30 minutes though. I mean, and what I found, I thought the same thing because I've been fired by painters at least 5 times, and that's no lie. And Gino knows it because I said it from the beginning. Painters have been the bane of my existence in multifamily because it can get very expensive. The flooring and the paint are some of your most expensive monthly costs, right? I shit you not, 5 times at least I've been fired. And what's come out of the woodwork in the last year is that there's a lot of these guys that are out there painting these complexes that are underneath, like you're looking for a company that specifically are in the multifamily niche. You just got to find them. It may not hurt developing relationships with property managers for some of the bigger complexes and finding out who they're using. Our network has grown, and we have about 3 groups right now that we're using, not just one, because what we find is these painters they'll turn over. You may get fired. You may have to fire them. Painters just we'll move on, but just so they're out there. Don't lose hope. All right, so they're out there.
Wow, you're exactly right. And the single family manager that I'm using right now recently hired a person that has multifamily experience, and she is now assigned to my account among other accounts. Mm-hmm. Her niece actually works for a property that is about a mile away from me. She lives in that property. She's got multifamily experience, and she has mentioned to me that she wants backups as well too. So we'll continue to foster those relationships and hopefully not get fired in the interim.
Have 2 or 3 on hand. It's you don't want to put all your eggs in one basket when it comes to painters.
Yeah, we ended up salvaging that relationship. We had I set up a conference call yesterday. Probably more active than I'd like to be with my management company, but in the end, if I put a little bit of work up front and have the right vendor in place and the right system in place, it'll go hands-free in the future.
Mike, what's your best real estate investing tip for the listeners?
Best tip. Am I actually qualified for that? I'll take you back to what I had mentioned earlier about having a broker or a real estate agent that's a closer. Be a closer yourself. The worst part of likely the worst part of being a real estate agent or broker is the number of tire kickers that you have to deal with, and the amount of time that literally sucks out of your job and the inefficiency it creates for you. So my suggestion is, get your education, get your mentorship, get your studying in, get a property or two under your belt for your experience. But then when you're ready to go and you've got your education behind you, be decisive, be aggressive, and close deals. I guess on the other side of things, too, I would also recommend, just being selective about who you get your advice from. There is a lot of really lousy advice that people provide in the real estate area, and most of them are coming from good places, but they're just describing what they're familiar with, and they don't have a good self-awareness of other strategies that are out there. They're very polarizing in their comments about, this is the only strategy, that is the only strategy. Just use your general business acumen, use your experience and background that you have and your decision-making skills, and buy what works right for you and close.
And now we will take a quick commercial break.
Are you stuck on the sidelines experiencing analysis by paralysis? Are you still trying to get your first multifamily deal done? We've never met an investor who's only done one deal. People are either stuck on the sidelines or they've done multiple deals. We always say that it's education times action that equal results. You've come to the education side of the equation. Let us help you land your first deal. Call Jake and Gino today at 904-314-9473 to set up a strategy session, or email us at gino@jakeandgino.com.
Woo! Love that guy. Now back to the show. Mike, what would you say your best habit for success is?
Probably have two habits. I don't know if this is my best one. I wouldn't recommend it for everybody, but I just work pretty insane hours between my W-2 job and real estate and my family. I don't watch much TV aside from sporting event here or there. And from the point that I wake up in the morning to going to bed at midnight, I'm wide open. Probably my best quality, though, that's a little bit more good for everyone, is that I'm just relentless. I will not let something go. If it takes me 5 minutes, if it takes me 5 hours, if it takes me 5 months, I just don't stop until I find the right answer and put the right system or process in place. I probably drive my family nuts. If I put something on my to-do list, I can promise you it's going to get done, and it'll stay on there, until it gets done.
They'll be thanking you when you have, a couple $1 million in real estate paid off, when a couple of years from now. So they're going to be fine. Don't worry about that. What's been the biggest mistake you've made since you've been in multifamily?
Oh man, I don't even know where to start. I mentioned going through the school of hard knocks. My biggest one though was on one of the flips. I paid a general contractor the second to last draw, and more often than not, that's the 90% draw point or 95% draw point, and I paid it too early, and he walked off the job right after that. This was a substantial flip. This was a couple $100,000 renovation. It was completely ripped down to the studs. All the mechanicals were replaced, and I just trusted him too much. It was a combination of being super busy, too much trust, and not diligent enough in making sure the payment lined up with the percent completion of the project, and lost a lot of money on that one. Didn't lose money on the flip itself, but I lost the profit that I should have made.
That's
big lesson.
What's your favorite book? Investing book? You say I know you listen to podcasts and stuff. What's your favorite investing book?
So I haven't read enough investing books over the course of my life really to say much on that one, but I will throw a shameless plug in here.
I will take it. We'll take it. I love it.
The Wheelbarrow Profits book I bought a couple months ago, and read it over the course of the weekend. And it outlines exactly everything we're talking about here today. It goes through the mom and pop strategy. and the value add that we've been discussing almost exclusively. And it sounds. The book is an easy read. The strategy is not a super complex strategy, and I know a lot of us will, sit around and we'll listen to podcasts while we're driving to work, or we're driving somewhere, or we'll listen to them while we're at the gym. There's only 30 minutes or an hour of content in these things, and sometimes it's hard to get really deep on things. But in the end, what you guys put together in your book and the strategy that you're following in your careers and allowed you to accumulate 700 units works. And even if it's simple, it doesn't mean it doesn't work. And your podcast and your book is a direct roadmap. And if somebody is willing to literally take notes and execute on that strategy, it provides a crystal clear roadmap of how to find a property, how to finance it, and how to make money in multifamily. And I think it's just super helpful, and it's real life, and it works.
Disclaimer: Mike was not prompted to say that, but we'll take it. So
now these guys are really down to earth. When I before I got invited to be on the podcast, I reached out to them through the Bigger Pockets website. They got on the phone with me for 45 minutes, and just helped me walk through a transaction. I don't have a partner, so I don't have someone to bounce things off of, and they confirmed what I was thinking about on a financing strategy for a property. Really super helpful, and honored to be part of the group here.
Line of credit, baby. We needed a line of credit, right? I remember that conversation like it was yesterday, because I was racking my brain. I'm thinking, how can we do that? And I'm like, line of credit works. I remember that.
Yep, and what's interesting about that line of credit, I'm like, I'm sitting here, and I'm not new to real estate investing. I've been doing it for 12 years, but I'm new to multifamily. And so when I called up my banker, and they said on the next acquisition, rather than doing a traditional amortizing loan where you've got to make principal payments, we will work with you on rolling your rehab into the line of credit. So we will pay for the rehab, and by the way, it's an interest-only line of credit for 2 years, so I don't have to make any principal payments during that time period. And so, it's just good to get confirmation from you guys on that, and a very flexible financing product.
Very cool. I took some notes just because there's definitely some really, really awesome stuff going on here. And the number one thing that I wrote down was I just love that real estate is helping support your family. At the end of the day, you're doing it because you're a family man, and it's helping the family out. And I love that stuff. Value add investor, and you just got a sense of responsibility to you, and that is like, I don't know if it's lacking into today's society or whatever, but you got a family, you got to take care of them. So you're out there basically kicking down doors, making it happen for the family, providing a lifestyle. And I'm just like, man, you're doing it, and just hats off to you on that. It really, I think it's great. We're using basically the same approach to what we're doing. So that just like it's just nice hearing that, and you're a make it happen guy. You're like, look, get out there and just do it. So this has been really fun. What is there anything else like a project that you're excited about right now that you want to share with the listeners, or is there any deals that you're hunting right now that you think you're going to land?
Yeah, so what I'm doing right now is rather boring. Looking for that tax CPA, looking for a bookkeeping package, looking for a tax attorney as well. That stuff isn't very exciting.
It's important though.
Yeah, and I've been vetting some larger multifamily management companies to get familiarity with what that model entails. Exciting to
steal vendors from them too, or employees.
Yeah, definitely. And there's some good ones in our market. So really looking forward to that. On this 29 unit property, we've got systems and processes in place. It's the fall right now, so it's not the best time to be turning units rolling into the holiday season. But now that the systems and processes are in place, I'll be able to accelerate the turns, coming in the late winter and early spring, and make some intentional turns and some rental raises. So speed that process up, and look forward to a potential either significant capital gain for my family, or cash out refinance and roll it into the next property. So that excites me.
Very cool.
That excites me too.
Mike, thank you so much for your time.
Guys, this was great. I really appreciate being part of the podcast and working with you guys.
Thanks, Mike. We appreciate it. Had a great time.
Take care, guys. Okay, that's going to do it for today. If you found value in this episode, please don't forget to leave us a review on iTunes. We really appreciate it. Also, if you'd like to speak with us, we are now doing 2 30-minute strategy sessions every Friday. You can sign up for these at jakeandgino.com. This has been another episode of the Wheelbarrow Profits Podcast, the only show that teaches that it's education times action that equals success. I'm Jake, and he's Gino. Over and out.
We trust that you enjoy the Wheelbarrow Profits Podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.